Welcome to our earnings discussions. For the banking sector, the Q2 result season is over. We went to the quarter fearing higher cost of deposits and therefore lower bank NIMs or margins and higher unsecured loans or NPAs. But at least for the big banks, say the SBI, HDFC, ICCI, Axis variety, the results have actually been a positive surprise on all these quarters. And now what are the trends for the current and for the next quarter? Will margins rise? Will they remain flat? Will deposit costs start falling? Or, are all these going to remain flat? And more importantly, what about loan growth? Because we have seen a soft quarter behind. Deposit growth has been higher than credit growth. So is there a loan growth issue in the coming quarters? For all these questions, I have with me Santanu Chakrabarti, the India analyst, BFSI at BNP Paribas. Good morning, Shantanu. Thank you very much for joining us. I want to go and do the past as well, the results gone by. But first, a para on, how should we see? Like I told you, we went into the result season troubling ourselves that NIMs will be under pressure, deposits are going through the roof, stuff like that. Now, is all that behind us? Can we see margins rising in the coming and current and next quarter?
First of all, good morning, Latha, and it's a pleasure once again to be chatting with you.
Thank you.
Look, our view on this margins thing has been that as far as on a pre-cut, rate cut basis, margins for the most part has almost bottomed out. Whatever incremental pressures are there on margins or through cost of funds is essentially in single-digit basis points from here on out, at least for the major banks. The reason for this is that the FD repricing bit, which was a critical driver of increase in cost of funds, is over. And sure, as long as CASA doesn't pick up, your FD proportion within the book goes up. And therefore, to that extent, there could be a couple of basis points here, there increases in some of the cost of funds. But on a pre-cut basis, definitely margins are very near a bottom. And any move from here is small. And that kind of has played out. It's played out better in some cases than others, but that seems to be the broad trend. Now, of course, margins will bottom post-rate cuts, right? And from there on, we actually see that as a positive from there on out because we feel that CASA will pick up, FD repricing downwards will start and so on and so forth, and will set the base for a further margin expansion from that point out.
No, just come again. At the moment, the Reserve Bank is keeping liquidity comfortable. It's in contrast to what it was over the average of the previous 12 months. As you point out in your report, actually in the past 12 months, if you take the average, the Reserve Bank has been tight. So yes. Won't that itself start bringing down the cost of deposits? Or you still think that deposits will remain high?
See, in itself, just without headline rates coming off at all, I don't think there is further play downwards in terms of deposits. That would be a little...
So unless there is a rate cut, deposits will not fall, you're saying?
No, they won't. And especially since, FD is the primary supporter of growth at this point. And you would have already seen that the headline growth for the month has actually come off quite a bit. This is one of the first quarters in a long time where deposit growth has been actually slightly in excess of credit growth. A situation which we had discussed in an earlier interview with you, where I had said that, this deposit growth slowdown thing, it's not that much of a worry. But what starts happening is that you start getting pickier about where you want to lend and where you don't want to lend. And broad credit kind of slows down a little bit. The appetite for corporate loans has slowed down even further. Now, what started off with somebody who's going through a major liability restructuring like HDFC being not too keen on corporate loans, now becomes a larger group, which is kind of backing off from rates that they do not like. So, we have to keep all of that in context. And yes, it would be too bullish to assume that, deposit rates will start to fall pre-rate cuts. But post-rate cuts, definitely yes. But post-rate cuts, more importantly, easier liquidity and easier money supply should drive, CA and SA respectively back up.
Okay. No, I wanted to follow up with a question on loan growth, but you've already touched it by saying you are expecting pressures on loan growth. I'll come back to that point in just a bit. Let me now go back to the laggard results and then ask you some futuristic questions. Right. In the results, is there a clear dichotomy? The big banks showed no pressure of unsecured loans, etc. But we did see that pressure once you come to a UCO, a Bank of India, even for that matter in an IndusInd because of its MFI, IDFC because of its MFI. Is there a clear distinction? Bigs did well. The mids didn't do all that well on asset quality.
Right, and you remember in our last conversation, I was mentioning that credit access, Grameen early disclosures have serious significance for the sector as a whole, because this is one of the most well-known, perhaps arguably one of the best-run MFIs in India. And here it was in its pre-disclosures, despite being geographically diversified, reporting a fairly significant sequential decline. Now, that's a very strong signal as far as asset quality on most other MFI portfolios go. Now, obviously, banks are a little better placed because the liability support at least is assured in their case to tide through whatever troubles that the MFI segments may face. So you'll see a lot of the underperformances that you're talking about, or disappointment of expectations rather for the quarter, have actually come from microfinance. Yeah. Yes, most people have reported a slight worsening within unsecured. Even ICCI Bank came out and said that their unsecured NPAs are also up a little bit, but it's not significant in the overall scheme of things too much for to alter your credit cost prognosis in a material way. You might have heard that SBI actually is perhaps the only large bank which came out and said we are not seeing much pressure. If anything, people are very willing to refinance our customers out. But other than that, the primary driver of disappointments actually been microfinance and not unsecured lending of personal nature.
Yeah, I think that was a very big takeaway from the results season. The Reserve Bank had put our antenna up, but it was not unsecured credit. It was microfinance, which disappointed and expectedly so, perhaps. Shantanu, you don't look at the public sector banks, but over there we saw some very good performances coming in from Canara, Indian, BOB. So do you think there is a choice of banks to pick now that the market is also lower? Of course, the big banks are doing very well, but is there a choice over there? I know it's not you don't have a report on it, but just your qualitative view.
So let me mention what stance we have taken on SBI, and perhaps that would help at least form a framework around how to think about some of the public sector banks right now. So in SBI, for example, we had an excellent beat out there, right? But we actually downgraded from outperform to neutral. Because we put a target multiple of 1.2 times 2Q FY27 core. And frankly, in the absence of a very sharp uptick in credit, say a corporate lending cycle starts, or a very sharp uptick in current account, savings account for the system as a whole, through a sharp monetary or liquidity easing, that practically, is the ceiling of my comfort zone. Okay. Especially where, the probability of a very healthy valuation raise at this point, which boosts book value and so on and so forth, is a little lower, probably versus 2-3 months back. Markets are a little less robust. So balance of probabilities, going higher than 1.2 is tough for me. Now, some people would argue that SBI has guided for 15% sustainable ROE. But the thing about a 1% ROA bank is that, its leverage and ROE are the same. So, to get to 15% ROE, you basically need 15x leverage. And whether or not the regulator smiles on that, there is a certain arithmetic associated with 15 times leverage. Okay. There's a certain fragility which comes inherent in that arithmetic. Okay. And that's where I define my comfort zone. I'm sure that in the bull market, some of these things will trade up at 1.5, 1.6. But I don't
Your comfort zone would be 1.2.
Pursuing that,
Okay. Fair enough. So would you say, therefore, that for the second half, the worry about bank earnings will be actually the amount of credit growth? In the first half, it was margin. Second half, it is going to be, corporates are not yet borrowing and banks are afraid to lend retail because of this unsecured worry.
Right. I mean, it's not that banks are not lending, Latha. It's just that they've come off the, if they were going in sixth gear, probably it's now third gear, right? Uh, Here's the conclusion that I'm increasingly coming to. That until rate cuts happen, and see, even on RBI's liquidity interventions, if you see, yeah, sure, they're more comfortable with allowing overnight surpluses. But on a net basis, they have still mopped up liquidity. They have not injected liquidity, even for this current fiscal, right?
Yes.
So liquidity needs to ease further. It has eased compared to earlier. And the monetary stance needs to change. So RBI, once it moves out of that inflation targeting mindset and towards a growth supporting mindset, and neutral is where its stance currently is when you'll see the pickup in credit growth, in our opinion. Because, unsecured, as you rightly said, it coming off a high base, the growth rates are now not going to look great. Look at things like CV, etc., which was supposed to be the savior of growth. You see what's happening within IndusInd on CVs,
Right.
which is clearly, I mean, whatever else you might say about IndusInd, it is very hard to fault the quality of its CV business, right? And some of those slightly higher yield things which were supposed to come to rescue of credit growth in the interim is not really playing out. It's not a major crisis or anything. It's just that probably the momentum isn't what one would have expected. So I'm starting to incrementally suspect that some amount of relief on affordability and asset returns through the prevailing interest rates in the economy would be necessary for a further uptick in credit growth. Now, I continue to assume, by the way, still a December thing, which is very counter consensus.
No, I won't buy that at all, because today the CPI number that will come will be perhaps 6 or even above 6. And that is the last number Reserve Bank will go into the policy with. I mean, they are in a tough spot. If GDP for second quarter comes at 6.5 and inflation is above 6, it's not easy for you to cut. Anyway, that aside, just a final question to you. This is not a banking question. It is your head of research or your strategist's question. In the scheme of things, where does banking stand? For the second half, does finance figure very high on your buy list, sectoral buy list?
Yeah, so BFSI has been an overweight area for us. It has continued to remain so for the last 1 year. Unfortunately, its relative attractiveness has only improved over the year, but hopefully it will work for us.
Okay. All right. Well, thank you very much, Shantanu, for joining us. I mean, your buys and the price targets have been anyway running as you spoke. And Shantanu's best buys are the top 4 banks. And of course, he also has Bajaj Finance as one of his top buys. Thank you very much, Shantanu, for joining us.
My pleasure, Latha.
Okay, so I think the big takeaway is that we have to wait for credit growth. We were wailing about the higher cost of deposits. Now we have to start seeing credit growth because corporates are still not borrowing as much as was expected. Let's see whether the second half turns out to be good. Let me